Hello and welcome. I'm Alex Proimos, Head of Institutional Content and Investment Magazine, and this is Market Narratives. This show is a series of unorthodox conversations with thought leaders influencing the world of fiduciary investors. For more related insights and analysis, please remember to check out our website, investmentmagazine.com.au, and subscribe for a free email. And with that, please enjoy this week's episode. Hello and welcome everyone. I'm joined by Désirée Lucchese, who's the Ethics and Impact Manager at Ethical. I'd say probably you're the most prolific person I've seen on LinkedIn of late, with endless posts about all sorts of discussions on geopolitics, stakeholder capitalism, environmental discussions, social discussions. I guess I think we should probably kick off as to what got you so enthused about this whole space.
Hello, Alex, and thank you for having me here today. Yes, I'm an avid reader indeed. So I'm a very curious person, and I got into responsible investment precisely because of the variety of issues and expertise that you need to have to be able to be a proficient, if not excellent, responsible investor.
I'm curious when you say that, because one of the biggest challenges I think is to read so broadly and at the same time make sure you can distill the information that you read into actual decisions. And how does that then influence what you do day to day?
It's a good question because, it's all about discriminating against what is material to your portfolio, what's happening within the macro landscape, and then really distilling it to make better informed decisions in your investment process.
As you then think about that in terms of building decision-making process or an investment framework, I guess the biggest challenge then is trying to work out what is material and what's not, right? There's a lot of things that we can all worry about. At the same time, if you sit within a portfolio and you're making decisions about a portfolio, what are the characteristics of what you would define as being material?
There are different levels of materiality. What investors to date have considered material, and what today, because of the complexity and really a flurry of issues, we are now starting to consider even more material. So there is a discussion in the ESG space about double materiality. What is material to the portfolio, to the sectors, industries, and constituents of a portfolio or an index, and what is material in terms of how the portfolio might impact the real world. So from a responsible investment lens, we need to discriminate against what are the values that we are upholding, what are the values of our clients. So what do we need to firstly exclude to meet those values? And then how do we integrate financially material ESG considerations that then help us identify opportunities while also mitigate downside risks to which our portfolio companies might be exposed to? It sounds relatively easy at this point in time, but when we're considering then sustainability materiality without conflating ESG investing and sustainability and sustainable investing per se, the picture becomes even more complex. So to date, we thought, okay, a company X might be performing a bit better on its packaging products. It might be lowering its carbon footprint in this regard. It might be trying to procure products from sustainable palm oil commodity traders. But ultimately, there was a very narrow and relative measure of sustainability. Today, in the face of an overt climate crisis, very urgent need to keep the world within a climate safe status, sustainability is a bit more than that. So the materiality is the materiality and the risk materiality is starting to broaden and become even more challenging for investors to discern.
I got to keep asking the question around an investment portfolio as you think about the traditional 60-40 portfolio with an equity bonds and then sort of going into the various verticals within the portfolio. How difficult is it to take a full portfolio in the old style, I guess, thinking of a mean variance framework to start embedding sustainability?
It is challenging, but there are so many new tools and framework of analysis that investors can already use and integrate. So firstly, we are starting to tread into uncharted territory, a world of uncertainty. And capital markets are blind to what we could define radical uncertainty. So the existing risk probability dispersion that we use to basically put a price on risk and then try to assess returns does no longer work in this world of high uncertainty. So there is a Nobel laureate, 1981, Robert Lucas, who said, in circumstances of high uncertainty, economic thinking that has no value. So what does that mean in practice? That we have to be thinking of the world today, the world in 2021, with new, models. We have to start shifting the model. So there are ways that investment teams can start integrating new thinking, looking at new frameworks, new tools to assess portfolio risk exposures. And then we all have to challenge each other and start building new expertise, have a bit more doubt and a bit more curiosity about the possibilities.
So as we think then, I guess, about the possibilities of change, for example, maybe, for a fund, is it best for them to start thinking about equities, for example, and then really maybe thinking about it more from a bottom-up perspective and understanding their underlying businesses that they're investing in and understanding the sustainability impact that these companies have? Is that the approach that we should be doing? Or should it really be a top-down approach as we think about the impact from sustainability across the whole equities framework?
Oh, well, all roads lead to Rome, as the old saying goes, and there is no one road to a solution. So there can be different styles. So, for example, we use a top-down approach, which is an exclusionary approach, and then we integrate, ESG risks and impact, lenses or impact, slants to the portfolio to then have a bottom-up analysis. So equities have exposures, but also debt. So what it takes is a broader understanding of risk. So there is, first of all, an identification of what could be a macro level compounding source of risk that could, then propagate across different stocks and securities, and then starting to basically identify and narrow it down within the time frame of your investment style.
So I guess the question then becomes, how do you think about pricing systemic risk, right? Because that's one of the things that you're trying to address and try to at least look out for, things that will affect you. But do you feel comfortable enough that you can identify companies that aren't susceptible to systemic risks?
Some systemic risk can be diversified against. And that's a hard truth for investment analysts. So what we can identify is the way those correlations might reverberate across different portfolios and different investment strategies. So a high risk, sector is by itself, by definition, probably something you might want to steer away from. At the same time, you can try and address who might be the winners within the high risk sector, and you can identify, the board, the board oversight that the company might have, the managerial capability, and the timeframes through which they apply their strategies. First of all, do they have a long-term strategy in the first place? And then, when you're looking at shareholder value, if you're considering shareholder value as an inherently forward outlooking measure, can that company be prepared to sudden and chronic shocks over the next 5, 10, 20 years? Ultimately, it is the time frame of your, investment style that determines to what extent you are prepared to account for those levels of risks and those different levels of materiality.
Then the question becomes, if you think about shareholder value, a lot of shareholder value is to do with the business, its ability to grow its earnings, and ultimately its valuation that comes from it. How much do you feel that monetary policy and fiscal policy that we're seeing around the world today being very accommodative is actually almost hiding some of these broader systemic risks?
I will not claim, not purport to be a monetary policy specialist. Of course, today we have to start thinking about new ways of understanding what we could do to transition our economies at large. So in that sense, and in that regard, monetary policy could be considered a way of financing fiscal policy. We've started seeing the ECB, and the Green New Deals trying to channel, new asset purchases towards new industries. At this point in time, it's probably a third of the actual, recovery plans in Europe. In every market, there's going to be winners and losers. So this is about, supporting the industries, the sectors, and the transformation that we require. And it will require, investment. It will require a cost. The point is, are we expecting those cash flows to come from a sustainable and resilient business? So can we distinguish between what is a robust investment strategy, a robust investment policy, and what could be resilient over the medium, long, and long term?
Because I raised the question because of the concern that really the pathway that we've been moving down in terms of lower and lower monetary policy and quantitative easing and a lot of support for a number of shares is really a market failure in a different way. We're allowing a lot of businesses to ultimately incinerate capital, and I'll say it pretty openly, which I think has no reference to sustainability from the way that they've been allowed to operate and to be able to run. But from an investor point of view, it's difficult because the whole market seems to be supported by very easy accommodative policy, whether it's through monetary policy or whether it's many of these fiscal programs that have come up off the back of COVID that are keeping a lot of businesses alive, and many of these businesses aren't sustainable. So, how do you then, as an investor, try to distinguish where to invest at the same time where you've got all these market forces that are being pushed upon you?
By identifying what could be zombie companies and by looking at where the latest research reports and direction of travel is heading. So, for example, the latest IEA report, the net zero report by 2050, is telling us very clearly that by 2050, we need to reduce coal as a percentage of total energy by 90%, oil by 75% of total demand, gas by 55%. So if we are to keep within a stable climate, which to me, considering we need to protect a life-supporting systems within which the economy and returns operate, then it is critical. So that's the direction of travel. In Europe, for example, just this year, we have had a 95 billion allocation to green bonds. So, of course, everybody is seeking yield. Everybody in this space is trying to ramp up some, alternative assets and green bonds or social bonds or climate bonds allocations. But ultimately, it's about the value of those structured products. So what's the quality of the issues? What's the quality of the proceeds? What is the direction of travel on which they are embarking on?
How much do you think the impact of this movement towards sustainability, green bonds, trying to reduce the impact on the environment actually has some pretty substantial impacts to the developing world, the emerging markets? The Western world has been very lucky. It's been able to run a 100-year process of significant gains off the back of commodities to a large extent, and off the back of oil and so forth. How can now the developing world, the emerging market part of the economy, be able to sort of take their self up to first world conditions at the same time as this pushback against really being quite concerned about the environment?
There has been a renewal of multilateralism. So we can see that, there are developing countries and, Western democracies, pushing for, greater allocations to sustainable and impact investments. So we know that from an impact side, the developing markets have had, lower benchmark, higher, outcomes to be achieved. And there was a relatively easy, I said relatively easy because the level of transparency in emerging markets has always been challenging. But in terms of today, where we sit, when we see the commitments that different countries, even the majority of Australian trading partners have towards decarbonization, we see that there is an increasing discussion of multilateralism and also approaching again the need to transfer technology, transfer expertise. Ultimately, it will be a tug of war about what's the most effective and least cost-heavy project. What could be best designed strategy within a certain investment outlook.
Because I think the way a lot of people think about this is that the Western world has done really well, but you've got this other part of the world being the third world, second world, and even China. Where does China sit in this? They have said 2060 they'll start to make some significant gains, but no one really believes it, much like their inflation and GDP numbers. It's really hard for, I think, a lot of people to look at the changes that are coming through, particularly as they see other countries almost shirking their duties. And there's a concern about whether even in Australia, there's a lot of discussion around the budget that was released about a week or two ago now around the amount of benefits that we got from commodities, $30 billion being this surprise upside that we've been able to capture through the rise in the price of iron ore. I'm not sure how willing people are to sort of take losses, financial losses, because of changes through environmental impacts that are coming through. And I think this is going to be the hardest thing. I don't think if you ask anybody, would they like to damage the environment, no one would actively raise their hand. I think that's pretty clear. But then the next challenge is, at what impact are you willing to take into your day-to-day living around the costs of living, the cost of feeding your family, the cost of living and buying a car and so forth. And I think this is one of the hardest challenges that we will have as we move through this process of sustainability. It's very easy to wave the flag and say, I'm going to do the right thing. But financially, how do you balance those things out is really critical.
We need new thinking and we need smart thinking. So firstly, we might say, well, yes, Western countries and Western democracies, are ahead of the game, but actually they're not necessarily ahead. I mean, there is a high degree of energy efficiency, productivity that we need to raise. We don't have the EVs infrastructure in place. We don't have, a gas infrastructure that is, covering for methane leakage. So it will be costly. But this is an opportunity for us to stimulate new job creation, new industries, more resilient sectors. So we might be thinking in Australia, oh, it's great, we can have a gas transition. But the reality is that countries like Europe will start, putting in place carbon adjustment mechanisms for imports. There will be new tariffs to drive a protection of their markets. So if our products and services do not comply with that greater sustainability lens, a climate resilient type of investment or product, we won't be up there trading. So I know that it is all perceived like a cost, but I think at this point in time, the greatest cost is actually not thinking in new ways and not accounting for those upcoming costs. I like to refer to the grey rhino as a great analogy for where we are at. We are thinking that it would be too costly now, but we have this massive, highly probable changes coming at us: new regulation, new technology, climate risks to actual collateral assets. So the actual value of collateral assets might be impacted by a flood event in Southern Asia. We have seen the fires in Australia. We know, glaciers are collapsing and the infrastructure we have is not prepared for, a 2-degree world, let alone a 3 or 4 degree world. So we've got high probability, high impactful events coming at us, charging. It's worse than an elephant in the room. These events are coming at us. The greatest cost is not acting now and starting having market dynamics, market forces doing their job, and governments on the other side, policymakers, investors doing their part on the other side.
This is where the markets are a really funny place, right? Because ultimately you talk about market dynamics and helping the market do its thing. But if you think about a lot of what we purchase today, we buy a lot of items that are truly throwaway items. You can go to any hardware store and buy a drill for $29 that lasts maybe 3 months and you just throw it away because you just buy another one. Likewise a TV. In the past, you would buy a TV and that TV would last you 20 years. Now, if it lasts you 3, you say that's a fine. I only paid $500 or $1,000 for it. That's fine. we're allowing this market environment to produce us products that are so cheap and so disposable. And yet we focus so much time and attention on sustainability in its impact with the climate, and ultimately trying to limit the change in temperature to 2 degrees, for example. But it seems like we're really missing the easier things up front, which is around the highly consumeristic society that we live in, and the amount of companies that we support when they keep having better and better results based on consumerism. Whether it's the companies like JB Hi-Fi, whether it's Coca-Cola, they're making huge amounts of product that then ultimately gets thrown away. It's disposable. And so it seems as though a lot of these large companies are very able to divert attention and start focusing on, we're doing the right thing about renewable energy. But if I pick on someone like Apple, you can't change anything in these computers anymore. It's just basically a throwaway item. Likewise, their phones. And there's no pressure from any of the investors to tell them, how can we do things better?
It's great that you're raising this point, because in a recent study about the Sustainable Development Goals and how these United Nations 17 Sustainable Development Goals are correlated, it appears that the ones that are most important are SDG 12, about reducing consumption and production, and actually responsible consumption and production, and reducing inequality in SDG 10. So it makes sense to think that if we are going to have sustainability embedded in our investment decision making, we need to account for how we're transforming the very production processes and services that we provide. And here we can learn significantly from sustainability practice. So on the one hand, we have ESG factors. So for investors who use financially material investment signals, so ESG can provide some elements of what would be a sustainable company within its specific services and products. And this could be about, responsible sourcing, about toxic emissions and waste, about the dematerialization, and so how the company integrates closed loops, life cycle analysis, and that really total cost of ownership in its product design and production. So again, linking it back to the IEA and the latest net zero by 2050 report, what we need is this dematerialization and really a dramatic, gain in efficiencies across energy generation and industrial processes. So we can, as investors and investment analysts, integrate considerations that are a bit more forward, forward oriented. And on the other hand, we can learn from sustainability metrics, which are a bit different. We need to distinguish between what is an ESG signal and what's a sustainability way of looking at the world. So when we are thinking of sustainability, we are thinking about smart design, modularity, closed loops, intergenerational equity. There is also the social justice element, because with sustainability, we're really thinking 10, 20, 50 years, up to 100 years down the line. Ultimately, it's about doing things smartly and conscientiously, because, we have realized that even charities can't handle all the, charitable, fashionable items that are being given to them. And the oceans can't handle all these microplastics and microfibers that get washed through, our, washing machines and discharged into the oceans. And in Australia, if you're considering, for example, plastic products, we have the highest use of plastics per capita. So we have to start thinking a bit more systemically. And we need to start thinking, where are our levers of influence? For example, we do not necessarily have plastic producers or petrochemical producers in our portfolio because we are fully divested from fossil fuels for clear ethical and environmental reasons. But how can we influence? So we have decided, okay, let's go through the retailers. Let's go through some packaging manufacturers. You can apply influence by having those discussions with those investee companies at the different levels of the value chain.
How much do you think that the influence through investors is sufficient enough, or should it really be through almost regulation and policy of government?
There are many barriers that we are facing as individuals, as investors, and as policymakers. So on the one hand, we have cognition biases, we have, variability through the way we analyze portfolios. And on the other hand, we have leadership voids. We have the need for policymakers to create the right incentives and incentive structures so that investors have some guarantee or some confidence in further investing in a market. So I think some recent pundits have done an assessment of all the large investors' initiatives across the board that might impact systemic risk that manifests in the capital markets through the systematic risk. And there are over 100 initiatives. So investors can do a lot within their investment teams to start influencing at different levels. Maybe it's an issuer, maybe it is the market maker, or maybe it's the investee company with which we are just having an active engagement strategy through proxy voting, through participating at AGMs and having really a voice and a position to raise an issue. And on the other hand, not really being quiet with policymakers. I think we've seen a significant ramping up of advocacy, of investors really collaborating across industry initiatives with peers to try and also, shift the discourse that is happening at the policymaking level.
Do you see any threats from this discourse in terms of businesses that then choose to almost go to the dark zone? There you almost get a terminology of dark capital where things are moving to the private markets. We've seen some anecdotal evidence, particularly in the fossil fuel space, where there's been a lot of divestiture from some of the very large Exxons and BP and so forth, but they're being picked up by private enterprise, which doesn't have the disclosures that you do have on public markets.
Well, this still matters. I mean, the most diversified investors and the largest, asset owners in the world will still have allocations to PE and venture capital. So the movement of transparency and accountability is actually now entering the private equity space. There is nowhere to hide. And ultimately, yes, there is a short-term return, and there is still a lot of money to be made from fossil fuels. The reality is, retail investors, wholesale investors, they will see through the facade. It's no longer the time to hide behind short-term smoke screens. The impact of investments are becoming more and more blatant.
I think you're a lot more positive than I am. I look to Bitcoin and these crypto assets absolute run up and now run down as being a really interesting observation in people's mentality. Despite everyone knowing the amount of energy costs that go in alongside these crypto assets, people choose to buy it. Everyone wants to get rich. Everyone wants to make money, right? And so this is one of the biggest dangers. It's people understand the risks. They understand the systemic risks. They understand the climate risks. And at the same time, there's this urge to get rich. And that comes back to my other question around, for investors, you've got benchmarks you've got to hit, whether it's quarterly, semi-annually, annually. We're all peer aware and we're all benchmarked. So, how do you think about this dichotomy that we face?
Oh, I'm happy you call me an optimist, because I would just call myself a realist, hoping that responsible investors can really shift the dial. So yes, I'm not an optimist, but thank you for that. So we need to distinguish between Bitcoins and crypto assets. And yes, I think the elephant in the room with Bitcoin was always energy consumption. And I think Bitcoin has got the energy consumption of the Netherlands. So we're talking about one currency, one asset having the consumption of an entire country. So whether we want to see that or not, it goes down to cognitive, limitations that we have as individuals or investors. As for the rally that I've also tragically seen, across crypto assets, many crypto assets do not necessarily have that level of consumption, and there are greater efficiencies that are built in. But ultimately, at this point in time, it remains a speculative asset that investors have to take at their own risk. So back to the benchmarks. How do we assess performance? So as a short-term investors or as a general investor, probably we will always refer to market cap benchmarks. But again, I'm a responsible investment analyst, a professional. So I'm seeing across the industry, across the interest there is, for example, in ESG ETFs, in active investment strategies, that we need to consider a different level of performance. And we are starting to find ways to account for it. There are ESG benchmarks, for example. So when I used to work at MSCI ESG Research, we used to run loads of portfolio analytics, and I used to run them for a broad range of superannuation, insurance companies, all clients. And we always used a secondary benchmark, preferably an ESG or low carbon benchmark, because as investors, if we are saying we are trying to be driving impact or lower portfolio, carbon footprint, then it wouldn't make sense that we compare it against the market cap benchmark in the first place. We could argue, is a benchmark representative of the economy, the economies in which we are investing in the first place? And I won't go into that. What I'm concerned about as a responsible and ethical investor is, am I comparing my performance to the type of world where I'm trying to steer to? So if I'm comparing myself to the market cap benchmark, then I wouldn't be achieving that goal. I will be failing to address the performance. And to make it a bit broader, if we consider, GDP growth between 1992 and 2014, GDP globally has increased 60%, while the decline on natural resources has been going down at the rate of 40%. So really, what are we measuring performance against? I mean, if we consider the economy a subsidiary of the environment, of nature, if we consider that businesses and portfolios have got not just impacts, whether to them or to the world, but also dependencies. Try and run a business without water. Try to run a business without a critical component to its supply chain, whether it is disrupted by a flood event or a fire or just a lack of talent. So we need to start thinking a performance through a lens of impact, dependencies, and value. Is that company or is that portfolio creating value for a diversity of stakeholders, but also for a longer, outlook?
Do you really believe that investors have that long-term outlook? I think that's one of the hardest challenges in terms of understanding what they would like, the utopia that they hope for versus their willingness to build wealth and provide a retirement for themselves, I think is one of the real challenges that people have when they put money aside. It's that balance that they need to have in terms of, can I make sure I've got enough wealth for my retirement vis-a-vis what can I do to help the environment? It's a challenging decision.
That's right. And you mentioned it earlier, that people or individuals are driven by the profit motive and having the returns now. I can't, answer on behalf of a very short-term investors. We are not a hedge fund, for example. So, and I understand that, of course, fixed income, investors would have very, short time frames. But ultimately, if we are, into the investment space for the medium to long term, each risk that we are now starting to see as a compounding risk as well will be material to that portfolio. So we tend to be using a time frame of 3 to 5 years, but actually most of our investee companies are held for much longer. So in that sense, we need to account for those risks. And as for asset owners, of course, it is the fiduciary duty to perform well so that there is a material financial return for beneficiaries to have to fall on to really retire. At the same time, most pension funds are now starting to realize that we need to ensure that we have a world in which we can retire in the first place. So that notion of risk makes sense to both returns and to sustainability themes that might be spanning across different, E and S and G aspects of a portfolio, whether fully accounted for or not. Because, for example, most of the, natural capital considerations, biodiversity considerations, or climate risk considerations are not necessarily yet integrated into the average ESG investment approach.
This is where the lens of fiduciary duty gets very, very blurred, because at what point is it impact investing where the returns are pretty much, close to cash plus something, versus being a fiduciary and your returns, or you're being benchmarked against a market return, or, a risk-free plus an equity risk premium, right? I think there's quite a distinction there as to what is the role of a fiduciary running a pension fund versus maybe an impact fund, which is looking to generate the most amount of impact possible.
Some impact investment, models are specific to impact, and a certain degree of impact projects that might make up a portfolio. But all investment can be investment with impact. So again, it's about the lens through which you pick your universe. So you define your universe and pick the stocks within that universe. So in that sense, every listed or fixed income investor can be an investor with impact. Again, it's about accounting for those, costs or risks that are usually not overt in investment analysis, and having the extra stretch, in intellectual curiosity, research, team skills to really go beyond what is considered mainstream investment analysis. So yes, fiduciaries have the responsibility for relative, market returns. At the same time, there is a broader impact that we can all have through our investment strategies. And the engagement that goes with them.
All right. That's been a fantastic conversation. Thank you very much for your time today, Désirée.
It's been great. Thank you so much, Alex.
Thank you for joining us. All views expressed on this podcast are subject to change and do not necessarily reflect the views of Connexus Financial. This podcast is for educational purposes only and should not be relied upon as investment advice.